Great to have your company for our final weekly of the year. Today, we're covering the key market trends, reviewing the biggest gainers, and sharing ideas on how to manage volatility. And we'll also unpack the biggest investing opportunities for 2026 and beyond. So let's get to it. Let's start with the investment trends. Well, this year, we saw record spending on AI and chips, and this boosted the US, the Aussie share market, and Hong Kong's market all toward record all-time high territory. We also saw strong demand for AI chips, and that also means we needed a lot more metals too. And as a result, commodity prices are around record all-time highs. And some of these gains in commodities actually produce better gains than the stock markets, the key ones that we just mentioned. Yet investors, I guess, really are perhaps maybe ignoring commodities, and this presents an investment opportunity. So that's a bit of a teaser before we unpack that later on. Let's just kick off with what we saw in the US. The Nasdaq 100 gained about 19%, the S&P 500 15%, the Aussie share market up 13%. Hong Kong's market did outstandingly well in comparison to that bunch, rising 27%. Now, let's reflect on the best performers in each of these key markets. What stocks made the most gains? Well, in the US, of course, no surprises. We saw computer hardware, storage groups, think flash drives and other data storage companies. Well, they topped the S&P 500. On the top, we had SanDisk up 490%. I bet you didn't see that coming. Western Digital also did really well, up 270%. And a company called Seagate, also in the hardware space, up almost 276%. And there was gold miners in on the rush too, pushing up the S&P 500. Newmont, which is listed both in the US and down under. Newmont is the world's biggest gold producer, and it notched a gain of 172%. What about the Nasdaq 100? Well, the top performer in that pinup index was Micron, up about 170%. Now, this is a high bandwidth memory leader. It operates alongside Samsung and SK Hynix, and their components, Micron's components, are basically essential in the chips that are needed to build out NVIDIA AMD's chips. Also in the Nasdaq 100, we saw other stocks do exceptionally well, such as Palantir. This is the global AI software defense group. It's up 134% this year. That's because they're inking more contracts with global governments. Down under in Australia, there's pretty much the theme of gold. Gold miners rose to the top. Regis Resources up 193%. That led a pack of 8 gold miners, dominating the top 10 gainers. Outstanding stuff. Let's also mention Drone Shield. That did pretty well despite a very turbulent year. It's holding a gain of 225%. Now, the only other top 10 really to note or take away from this is Liontown. Liontown doing really well. That's because lithium is a key sector to watch, rising on the back of the lithium price, indeed moving up off its lows. We also have to look at Hong Kong. Again, that market up 27% this year, a top performing global stock market. Calling out a couple of standouts, we saw aluminium producer China Hongqiao. That tops the market there, up 190%. Leading the gains in Hong Kong's Hang Seng. And then, of course, in second place, gold and copper miners did really well, such as Zijing Mining, up about 150%. Also in Hong Kong's market, healthcare groups are doing really well, such as JD Health. That also dominates the leaderboard. And in Europe, we're also seeing similar themes as well. In Hong Kong's market, don't forget Labubu. The Boo parent company Popmart is also in the leaderboard. And one more quick note, in Canada, a company that goes by the name of Canada Discovery Silver looks like the biggest large cap gainer of all. It's up 1,193% this year. So there you go. As for commodity prices, they've far exceeded the returns of the key markets that we just mentioned. If you think about platinum, that's done exceptionally well, outperforming other commodity prices. Platinum up 113%. Actually, I will stand corrected and correct myself. Silver's actually up more than that. Silver's up about 130%. We've also got gold in hot pursuit up 65% and copper's up 32%. But what we need to take away from this is the long-term trends for AI. They seem really intact. And these four markets, they've never moved in a straight line. So we're talking about the S&P 500, the Nasdaq 100, Hong Kong's Hang Seng, and Australia's share market. Again, they've never moved up in a straight line. And all key indices have experienced some type of correction or crash throughout history, but these four key indices throughout history have always recovered over time. So that's something for you to think about. Now, on the topic of trends, if you were to chuck in any AI bot that you use and ask AI what the hottest trends are in the investing world, you'll probably get a response from that saying that AI is the hottest investment trend. Ask again AI where the markets could crash and why, and you'll probably hear a lot of things like AI anxiety, AI bubbles. And now this is the other thing that markets are grappling with right now. There's concern about falling cash flows in some companies and rising debt levels. So AI is both, I guess, the market medicine that's pulling us up, but it's also a jagged little pill that's causing our markets to experience pullbacks, speed bumps, perhaps, if you will. Now, this anxiety is, of course, impacting sentiment, and that explains why global share markets, such as the ones in the US, the S&P 500, is down off its high. It's not down by much. Off its high as we stand at the time of recording this, the S&P 500 is down about 3% from its record all-time high. The pin-up index, the Nasdaq 100, that's down about 6%. Hong Kong's market is down 7% from their record. And down under in Australia, our market is down about 6% from its record all-time high too. So while markets could see further falls in the short term, it remains a no-brainer, I think, that the strongest growth sectors right through to 2030 will be those tied to tech and AI. The market may simply just need to adjust in the near term, and that's something that we all need to consider. We also need to consider while equity markets are down from their highs, commodities are delivering far superior returns in comparison to the major markets that we've just been touching on. Now, commodities, they're shining, and that's for a couple of reasons. The US dollar has fallen sharply, but commodities are benefiting from the rise of AI. Also, the rise for commodities essential for the medicinal, automotive industries as well. And the ETFs that are tracking some of the key commodities, particularly in precious metals, are far outperforming every major stock market that we just touched on. So we really think, or I really do think, that this is perhaps maybe a wake-up call that commodities do deserve a place in your investment portfolio, and we'll cover why they're positioned for further upside later on. Now let's change pace and dive into Moomoo's Magnificent 7, the most traded stocks and ETFs by Moomoo traders and investors across the year. Here's a look at the 7 most traded stocks this year at Moomoo. In top place is Nvidia, the most traded stock of the year. It was the same case for 2024 as well. But one of the most notable trends is that Tesla has moved up from the 4th most traded stock in 2024, and this year it's the 2nd most traded. Also, a fun fact for you, ladies and gents, that these stocks are bought each quarter globally, but also by tech investors because they form major parts of the biggest tech ETF in the world. That's the QQQ ETF. Nvidia makes up 9.1% of the QQ ETF. Tesla makes up about 4%. Let's move to the most traded ETFs this year by Moomoo traders and investors. Really standing out like a sore thumb are ETFs tracking the Aussie share market, such as VAS. ETFs also tracking global markets, such as VGS, which invests in 1,300 companies across 23 countries. These two ETFs, VAS and VGS, were the first and second most traded ETFs. While also, you have to note that ETFs that track the S&P 500 are also a major feature of what people are trading here. What does all this mean for next year? So where will the biggest opportunities will be? Well, the biggest drivers of investment returns next year and through to probably 2030 is without a doubt the trillion-dollar freight train of spending headed for the AI economy. It's not just me saying this, but Bloomberg Intelligence is also saying this is where we're probably going to see the best investment returns over the longer term. Now, if estimates are correct, global AI spending is expected to rise from about 390 billion US this year up to 540 billion US dollars next year before surging to about 3.4 trillion US dollars in 2033. So if this happens, this basically means some of the strongest earnings growth and therefore the best investment returns might probably come from key beneficiaries of the massive build out of AI. So what does this include? Well, chip makers, data centers, as well as companies supplying the raw materials to build the AI infrastructure. So that means silver, platinum, aluminum. You say aluminum, I say aluminium, copper, gold. Now, these areas are key sectors, thematics to watch. They're already signaling strength. And that's what the market is telling us. They are key pillars that could drive some of the strongest returns for markets for a little while to come. Being a little bit more specific about, I guess, a market approach, the Nasdaq 100 and Australian miners, they are also poised to deliver some of the strongest earnings growth. So Nasdaq 100 companies are expected to see earnings growth of about 18% next year and 18% the year after that. While Aussie's mining sector, or Australia's mining sector, is expected to eclipse that and deliver earnings growth of 28% next year and about 7% the year after that. That's something for you to consider. But do consider if you are a trader or investor, of course, we need to remember markets don't go up in a straight line. Next year, the journey is probably higher, but it's going to be very, very, very bumpy. Why do I think that we could see pullbacks? Perhaps some traders will be using this as buying opportunities. Well, it's due to perhaps weaker economic data that might come out. We also might see renewed geopolitical tension, or maybe we see even greater concerns about this AI bubble. Now, either way, market pullbacks are likely. It's happened throughout history, but buying and paying attention to the right high quality stocks aligned with key long-term themes, we often use pullbacks as a buying opportunity. This is what the brave do, and also the long-term investor typically does this as well. And this is how we've seen long-term generational wealth built over time. That brings us to volatility management and planning for the year ahead. There are a couple ways to minimize volatility. One of those is the old school PAPS philosophy that investment managers do. Some investment managers, that is, and they typically build diversified portfolios across different sectors of the market. But if you take a Warren Buffett approach and actually lean into what he said, he actually famously said, diversification may preserve wealth, but concentration builds it. So if you are a savvy investor and you're prepared to do a little bit of research and you don't mind getting stuck into the nitty gritty, which a lot of traders and investors do here at Moomoo, you can manage risk and volatility by also doing what professional traders do, and that is being really stock specific, focusing on those high quality companies that have got strong histories of recovering and they've got strong rising cash flows, strong forward growth estimates. And you might look to buy some of these stocks or key indices when you experience pullbacks. The second thing that you might like to do is, besides buying high quality names and market pullbacks, is then look to take profits, sell some or sell all maybe, after you see a strong rally. What is a strong rally? Well, for you or a fund manager, it might be after that stock or ETF that you've bought into has rallied 15 to 20%, whatever your target return is. And then you basically rinse and repeat. Now, this is what a lot of investment managers do, but the key is you need to stay focused and stay the course focused on those key stocks and sectors that are exposed to those long-term drivers of returns. Again, long-term drivers are supported by strong forward earnings growth estimates, earnings upgrades drive share price growth, and all in all, these drive long-term share price growth potential. In the description below, we're going to link a couple of things that we've discussed today, so please check them out for further information. And for more information on stocks and ETFs that we've covered today, head over to Moomoo's platform and you will find everything you can. Stay safe, happy trading.